Imagine risking $100 on a trade and walking away with $200 or maybe $300. Which one would make you richer over the next year? It sounds simple, right? But here's the shocking truth. Most traders get this completely wrong, and it's why even the most winning strategies fail to make real money. Today, we're going to unravel the exact truth behind the 1-to risk-reward versus 1.3 risk-reward, and I promise, by the end of this video, you'll never look at trading profits the same way again. Hey, I'm thrilled you're here. If you're watching right now, make sure to hit like, subscribe, share this video, and drop a comment about the exact time you're watching from, because we're diving deep into a topic that could completely change the way you see your trades and your profits. Now let's get straight to it. Risk-reward ratios. Most traders think it's just a number. Oh, 1-2 is smaller, 1-3 is bigger. Obviously, bigger is better, right? That's the kind of thinking that destroys accounts over time. See, it's not about just picking a higher reward. It's about how your psychology reacts to wins and losses, your win rate, and how compounding really works in the real world. Let me take you back to a story. There's a trader named Alex. Alex started trading with a 1.3 RR mindset, thinking every winner should triple the risk. He thought, I'll just get a few big winners and I'll be set for life. On paper, it looked perfect. His first trade risked $100 to win $300. The trade worked, and he felt invincible. The second trade also hit, and again he made $300. But here's the catch. On the third trade, he hit a loss, and then another. Suddenly, those two wins weren't enough to cover the cumulative losses. Alex's psychology started breaking down. He hesitated to take the next trade, overanalyzed, and then revenge traded. The dream of triple profits quickly turned into a nightmare. Contrast that with another trader, Sarah, who focused on a 1.2 RR. She wasn't looking for massive single-trade profits. She was disciplined, consistent, and focused on executing her edge repeatedly. Her profits were smaller per trade, yes, but because her strategy matched her psychology and win rate, she ended up compounding her account steadily. Over a few months, Sarah's smaller wins grew her account more reliably than Alex's high-risk strategy ever could. Now, you might be asking yourself, so is 1-2 really better than 1-3? Or is it the other way around? That's exactly the question we're going to answer today. But to truly understand, we need to break down the hidden mechanics of risk-reward ratios and how they interact with win rate, trade frequency, and emotional resilience. First, let's talk about math, but in a way that actually matters for real-life trading. Most traders look at a 1-2 RR and think, I only need to win 33% of the time to break even. And that's technically true, but what they fail to realize is that your trading frequency, drawdown risk, and the emotional stress of losses can change the outcome completely. For example, imagine you take 9 trades. With a 1.2 RR, you risk $100 each trade, hoping to make $200 each win. To break even, you technically only need to win 33%, which is 3 trades. But if those 3 wins are scattered between 6 losses, the sequence alone can feel catastrophic. Suddenly, your psychology is stressed, your confidence wavers, and your discipline starts breaking down. Now, with a 1.3 RR, your break-even win rate drops to just 25%. That sounds better, right? Fewer wins needed to be profitable? On paper, yes. But in reality, the higher reward often means trades take longer to hit their target, which increases exposure to market noise, impatience, and decision fatigue. And let's not forget the pullbacks and losing streaks. A single string of losses in a 1.3 RR strategy can feel devastating and often leads traders to chase trades or increase risk irrationally, destroying the edge they thought they had. This is where most educational content fails you. They show beautiful charts and hypothetical trades, but they never address the psychological side of risk-reward ratios, which is the real reason most retail traders fail. Trading isn't just math, it's behavioral mastery over your own emotions. And this is the secret that will separate profitable traders from those who look like winners on paper but are bleeding capital behind the scenes. Let's pause for a second. If this is already resonating with you, hit that like button, subscribe, and share this video with a friend who's struggling with trading discipline. Drop a comment with the exact time you're watching because I've got some insane examples coming up that most traders never see, and you'll want to reference this video later. Now, here's a critical point. The perceived profitability of 1.2 versus 1.3 is not static. It depends entirely on your win rate and trade psychology. Let's illustrate this with some real numbers. Trader A, 1.2, RR, 50% win rate, 10 trades, wins $200 on 5 trades, loses $100 on 5 trades. Net profit, $500. Trader B, 1.3, RR, 40% win rate, 10 trades, wins $300 on 4 trades, loses $100 on 6 trades. Net profit, $600. On the surface, Trader B makes more money. But notice the emotional difference? Trader B just took 6 losses in a row. That's a psychological blow most retail traders can't handle. Trader A, even though making less profit, maintains consistency, confidence, and composure, which compounds into long-term profitability in ways raw numbers don't show. Here's the takeaway. Profitability isn't just about RR numbers. It's about your ability to stick to your strategy through the inevitable losses. This is where traders fail. They chase big rewards, underestimate the emotional strain, and then sabotage themselves. And this is exactly what we'll break down in the next section: how trader psychology interacts with different risk-reward ratios, and why the higher reward is not always the most profitable. We'll also cover how to calculate your optimal RR based on your actual win rate and emotional tolerance, not just theory. Before we move on, I want you to do something. Hit subscribe, like, share, and comment below the time you're watching this from. These actions aren't just clicks. They help me know who's serious about mastering trading psychology and real profitability. And trust me, what's coming next will make you rethink the way you plan your trades forever. So stay tuned, because in the next section we're going to dissect the true math of risk-reward ratios, show you real examples of streaks and drawdowns, and reveal the hidden edge that most traders completely miss. Once you see it, the choice between 1.2 and 1.3 RR will be crystal clear, not just logically, but intuitively, so you can trade without hesitation. If you're still with me, awesome. And if you haven't yet, take a second to hit like, subscribe, share this video, and comment the exact time you're watching. Because the examples we're about to go through will likely make you rethink every trade you've ever taken. Now let's talk numbers, but not just numbers on a spreadsheet. Numbers that truly reflect real-life trading experiences. We already touched on the fact that 1.2 and 1.3 risk-reward ratios aren't inherently better or worse. The key lies in win rate and how streaks of wins and losses affect your account and mindset. Let's say you're trading with a 1.2 RR and your win rate is 50%. Sounds straightforward, right? You risk $100 to make $200. Statistically, every 2 trades net a small profit. Win one, lose one, you're up $100. That's simple math, but let's explore it over a series of trades. Imagine a streak. You lose 4 trades in a row. That's $400 gone. Then, you win 2 trades, $400 gained. Mathematically, you're back to break even. But here's where the psychological factor hits. After 4 losses, your confidence is shaken. You start questioning setups, hesitating on entries, and maybe even skipping trades that fit your strategy perfectly. That's the hidden cost of loss sequences, not just the dollar loss. Now let's flip to 1.3 RR. You risk $100 to make $300. To break even, you only need to win 25% of your trades. Sounds magical, right? only 1 in 4 trades needs to win, and the rest can be losers. You still profit. But here's the catch. Losing streaks feel worse. Losing 6 trades in a row in a 1.3 system wipes out $600. If your win rate isn't perfectly consistent, that streak can cripple confidence, even if statistically the system is profitable over hundreds of trades. This is where most traders fall into the trap. They focus on higher RR equals more profit, without accounting for human psychology, emotions, and real-life streaks. You can win on paper, but if your mindset collapses mid-drawdown, all the strategy math in the world won't save you. Let's make this visual. Imagine your account balance like a roller coaster. 1.2 RR is a moderate ride. Ups and downs are noticeable but manageable. 1.3 RR is a bigger roller coaster. The highs feel exhilarating, but the lows feel terrifying. Most retail traders get off the ride at the bottom, thinking the system doesn't work, even though it's mathematically profitable. To truly understand profitability, we need to blend math with psychology. Let's calculate some realistic scenarios. Scenario 1, 1.2 RR, 50% win rate, 20 trades, wins, 10 trades, x $200 $2,000, losses, 10 trades, x $100 $1,000, net profit, equal $1,000. Scenario 2, 1.3 RR, 35% win rate, 20 trades, wins, 7 trades, x $300, $2,100, losses, 13 trades, x $100, $1,300, net profit, x $800. Wait, did you catch that? Even though the reward per trade is bigger in the 1.3 scenario, the net profit is actually less than the 1.2 scenario because the lower win rate increases the cumulative losses. That's the subtle truth that almost no trading course emphasizes. Profitability isn't just about reward, it's about consistency, win rate, and emotional resilience. And this is where the story gets even more interesting. Imagine Trader B, who goes with 1.3 RR, sees 3 consecutive losses early in the day. Confidence drops. Fear creeps in. Now, the next trade, one that perfectly fits their strategy, they hesitate or second guess. That's one profitable trade lost not because of the system, but because of human behavior. Trader A, running 1.2 RR, has smaller wins and losses. They feel less pressure after each trade. Their psychology stays intact, and they continue executing their plan with discipline. Over time, those consistent smaller wins accumulate into larger, compounded profits. Here's a critical insight most traders overlook. Risk-reward is only profitable when aligned with your psychology. A mathematically superior RR ratio can be disastrous if your mind can't handle the drawdowns. Conversely, a lower RR system might produce less exciting single-trade results, but can yield greater long-term profitability because you stay consistent, disciplined, and emotionally stable. Let's dig deeper into streak probabilities because they reveal the hidden dangers of higher RR ratios. For a 1.3 RR trader with a 40% win rate, probability of losing 4 trades in a row equals 0.6 x 0.6 x 0.6 x 0.6 equals 0.1296, roughly 13%. Probability of losing 6 trades in a row equals 0.626, 4.6%. That might sound low, but consider a trading week with 20 trades. Losing streaks happen more often than most traders expect. Experiencing even one streak can trigger fear, frustration, or revenge trading, eroding the edge of the system. Now, compare with a 1.2 RR trader with a 50% win rate. Probability of losing 4 trades in a row equals 0.5244 equals 0.0x25, 6.25%. Probability of losing 6 trades in a row equals 0.56, 1.5%. The streaks are shorter, smaller, and psychologically easier to handle. This gives you more mental bandwidth to continue trading properly, which in trading is often more important than the raw RR numbers. Here's where we combine math plus psychology plus execution. Match your RR ratio to your win rate. A higher RR works if your win rate is consistent and you can tolerate streaks. Evaluate drawdowns realistically. Know the largest losing streak your system might encounter and whether you can emotionally handle it. Consistency over glory. Many traders chase 1.3 RR like a lottery ticket. The real edge comes from executing a strategy consistently, even if the RR seems smaller. And if you're still watching, it shows you're serious about improving your trading. So go ahead, hit that subscribe button, like, share, and comment the time you're watching. These small actions help us build a community of traders who understand that real profitability is about strategy and psychology combined. Next, we'll explore the hidden advantage of 1-2 RR in compounding your account and why smaller, consistent wins often outperform high-reward trades over the long term. We'll also look at real trader examples, showing how accounts that chase 1.3 RR frequently stall, while disciplined 1.2 traders grow steadily. By the end of the next section, you'll understand not just which RR ratio is mathematically better, but which one aligns with your brain, your psychology, and your path to long-term profits. And that's the game changer most traders never learn. So, stick around. The next part will reveal the surprising truth about compounding and risk-reward ratios, and why the obvious choice might actually be the wrong one. If you've made it this far, it shows you're serious about understanding the real mechanics of profitability. And if you haven't yet, take a moment to hit like, subscribe, share, and comment the exact time you're watching. These small actions help support content like this and let us know who's ready to take trading seriously. Now, let's get into the compounding secret that almost no trader talks about. Most retail traders are obsessed with the big win. They focus on 1.3 RR trades, thinking one massive winner will cover months of losses. But here's the harsh truth. Trading isn't about individual wins. It's about how your wins and losses compound over time. Let's imagine a trader. Let's call him Mike. Mike starts with a $10,000 account and uses a 1.2 RR strategy. He risks 2% per trade to make 4%. His trades are consistent with a 50% win rate. Over a month, Mike takes 50 trades. The average outcome, 25 wins, x 4%, equals 100% gain cumulatively on his risked amounts. 25 losses, x 2%, equals 50% loss cumulatively. Net gain equals 50% of the account. That's $15,000. Not a single trade made him rich, but compounding small, consistent wins while controlling losses created massive growth over time. Now, compare this with a trader using 1.3 RRR. Let's call her Lisa. Lisa risks 2% per trade to make 6%, but her win rate is lower, around 35%. She also takes 50 trades, 17 wins, x 6%, x 102%, gain cumulatively 33 losses, x 2%, or 66%, loss cumulatively, net gain, x 36% of the account. That's $13,600. Notice the difference. Even though Lisa went for higher rewards, Mike's smaller but more consistent wins produced better growth. This is compounding in action. Steady, achievable profits grow faster than occasional big wins that are psychologically hard to stick to. Here's the lesson most traders ignore. Profitability isn't about hitting home runs. It's about hitting singles consistently and letting them compound. Now, let's break down the emotional side, because numbers alone won't make you a better trader. Imagine Lisa on a losing streak. With a 35% win rate, she could lose 5 to 6 trades in a row, wiping out $10 or 12% of her account. This feels painful and creates mental fatigue, leading to hesitation, revenge trading, or abandoning the system entirely. Meanwhile, Mike's 1-2 RR setup might see him lose 3 to 4 trades in a row, but the smaller drawdown feels manageable. He stays calm, follows his plan, and continues trading with discipline. Over time, his account grows reliably. Here's a real-world analogy. Think of two runners in a marathon. One sprints in bursts, thinking each burst will get them ahead, but burns out quickly. The other runs at a steady, manageable pace, passing the sprinting runner eventually. Trading works the same way. Compounding with smaller, consistent wins beats occasional massive wins if you want long-term sustainability. Let's make this even more practical. Most retail traders ignore trade frequency, which directly impacts compounding. A 1-2 RR strategy often produces more frequent winners because the targets are more achievable. More winners equals more compounding opportunities. A 1.3 RR strategy hits fewer winners, so each win has to carry the weight of multiple losses. Less frequent wins equals slower compounding and more stress per trade. This is why many traders look at a 1.3 system on paper and think it's more profitable, but in reality, it's harder to execute consistently. The execution gap is where most profits are lost. Now let's talk about drawdown management, which ties directly to RR and compounding. Drawdowns are inevitable. Every trader experiences them. But the size of your drawdown determines how quickly you can recover. With 1-2 RR, drawdowns tend to be smaller because each loss is a smaller portion of your expected reward. Recovery is faster. A 10% drawdown requires an 11% gain to recover. With 1.3 RR, drawdowns can be larger due to higher volatility in wins and losses. A 15% drawdown now requires an 18% gain to break even. The higher the RR, the more psychologically taxing recovery becomes. And here's a key insight most traders overlook. Consistency compounds confidence, which compounds profits. You can make the math work in a 1.3 system, but if you lose confidence during drawdowns, that system becomes unprofitable. A 1.2 system aligns better with human psychology, making it more likely to produce long-term profits, not just theoretical profits. Let's bring in a practical example from professional trading. Many of the most successful traders, including those managing millions, use modest RR ratios paired with disciplined win rates. They don't gamble on 1-5 or 1-10 trades. Why? Because large RR trades introduce emotional instability, larger drawdowns, and execution errors. Instead, they maximize the number of consistent, achievable setups, which compounds steadily. Here's an insight that will change how you view trades. Profitability equals frequency. XRR. Ease, execution quality. Psychological sustainability. You can't look at RR in isolation. It has to fit your win rate, trade frequency, and emotional capacity. Now, let's talk about one of the most misunderstood aspects of RR, how losing streaks affect compounding differently for 1.2 versus 1.3 trades. For a 1.2 trader, a 4-loss streak at $100 risk equals $400 lost, with 25 wins at $200 profit equals $5,000 earned. Losses feel manageable, confidence intact, compounding continues. For a 1.3 trader, a 4-loss streak at $100 risk, $400 lost. But with fewer wins at $300 each, recovery takes longer and emotional strain increases. Compounding stalls until the streak ends. The takeaway: smaller, manageable wins allow compounding to work faster, even if your RR per trade is smaller. This is the hidden edge that most retail traders completely miss. And if you're still with me, it shows you're serious about mastering the mental and mathematical side of trading. So pause for a second, hit like, subscribe, share, and comment the exact time you're watching. It helps me create more content that cuts through the noise and delivers real trading insights. In the next section, we'll take this to the next level. We'll break down real-life trade sequences, showing how 1.2 RR strategies consistently outperform 1.3 in terms of account growth, emotional stability, and compounding efficiency. We'll even simulate months of trades to make the difference crystal clear. By the end of that section, you'll not only understand which RR ratio is mathematically better for your account, but also which one your mind will actually stick with through the inevitable ups and downs of trading life. Because here's the truth most traders never hear. Trading is not about chasing the biggest wins, it's about compounding confidence and discipline into consistent profits. And that, more than any RR ratio, is what separates profitable traders from frustrated ones. If you're still here, you're clearly committed to understanding what actually makes traders profitable. And if you haven't yet, pause for a second. Hit like, subscribe, share, and drop a comment with the exact time you're watching. Trust me, the next examples will completely change the way you view your trading strategy. Now, let's dive into real-life trade sequences and see exactly how 1.2 and 1.3 RR strategies behave over time. Because numbers in theory are one thing, but seeing actual sequences is where the truth hits home. Imagine a trader, we'll call him Tom, starting with a $10,000 account. He decides to risk $100 per trade. Tom runs a 1.2 RR system with a 50% win rate and trades consistently over a month. Here's a simplified sequence of 20 trades: loss, loss, win, loss, win, win, loss, win, loss, win, loss, win, win, loss, win, loss, loss, win, win, win. Notice the pattern? Even though there are multiple losses scattered throughout, each win is manageable and psychologically sustainable. Tom's 1-2 trades hit more often, and he experiences less emotional drag. By the end of the month, his account has grown steadily, and importantly, he didn't panic, hesitate, or abandon his system. Now, let's look at a 1-3 RR scenario with the same account and trade frequency, but a lower 35% win rate. Loss, 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 win, loss, win, loss, loss, win, loss, loss, win, loss, win, loss, 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 win, loss, win. See the difference? The losses feel more punishing because each streak hits harder emotionally. Even if the system is profitable on paper over 100 trades, the psychological strain creates hesitation, doubt, and suboptimal decision-making. Many traders abandon this system midway, leaving profits on the table. This is the real power of aligning risk-reward ratio with your psychology. Numbers don't exist in isolation. Your mind interprets each sequence and reacts accordingly. Now let's simulate months of trading to quantify the difference in account growth between 1.2 and 1.3 RR systems. Trader A, 1.2 RR, 50% win rate, 50 trades, month. Average profit per trade, $200. Average loss, $100. Net monthly growth equal $5,000. Compounded over 6 months, $40,000. Trader B, 1.3 RR, 35% win rate, 50 trades a month. Average profit per trade, $300. Average loss, $100. Net monthly growth equals $4,000. Compounded over 6 months, $37,000. Notice something subtle but crucial? Even though Trader B went for bigger wins per trade, the lower win rate and psychological strain slowed compounding, making the total account growth smaller than Trader A's. This illustrates a principle that rarely gets emphasized. Profitability is a function of RRX win rate, X compounding, X psychological alignment. Now, let's talk about sequence stress and drawdown resilience, because this is where most traders fail. In the 1-3 system, losing streaks are more impactful. Losing 5 trades in a row with a 35% win rate can wipe out 15 to 20% of your account. Even if the next trade wins, it doesn't fully restore confidence. You may hesitate, skip setups, or revenge trade. This behavior erodes the edge of your system faster than the math predicts. In contrast, the 1-2 RR trader, with smaller and more frequent wins, suffers smaller drawdowns. Losing 3 trades in a row might only impact 6% of the account. The streak is manageable, and the trader continues trading without fear or hesitation. This allows compounding to function smoothly. Confidence compounds along with the account. Let me give you a practical example of how real professional traders implement this concept. Many of the most consistent traders in futures, forex, and equities favor modest RR ratios, 1.1.5, 1.2.5, combined with strict risk management. They don't wait for perfectly huge trades because these often arrive too infrequently, and missing them doesn't hurt the account significantly. Instead, they focus on identifying repeatable, achievable setups, executing them consistently, and letting compounding do the heavy lifting over weeks and months. This is the hidden advantage of a 1.2 RR system. It maximizes compounding, minimizes emotional stress, and ensures your edge isn't lost due to human psychology. Here's another interesting insight. The speed of compounding matters psychologically. With a 1.2 system, frequent small wins reinforce confidence and maintain discipline. You see your account grow steadily, which motivates you to stick with the strategy. With a 1.3 system, infrequent wins can make you question your strategy, even if the system is profitable mathematically. The emotional lag slows execution, reduces trading frequency, and indirectly limits compounding. This is why so many retail traders fail chasing high RR setups. They underestimate the mental toll of losing streaks. They focus on what could be won, rather than what can realistically be executed consistently. Now, here's a key takeaway. The most profitable RR ratio is the one you can execute consistently while keeping your psychology intact. Let's put it into perspective. If you can stick to a 1.3 RR system perfectly with a low win rate, it will be profitable. But very few traders have the mental capacity to endure repeated losses and maintain discipline. If you can consistently execute a 1.2 RR system with a slightly higher win rate, your account grows faster over the long term because compounding, confidence, and discipline align perfectly. And if you're still with me, this is the moment to pause and like, subscribe, share, and comment the exact time you're watching. These actions aren't just clicks. They connect you with a community of traders who understand that real profitability is about consistency, compounding, and psychological alignment, not just chasing huge RR numbers. In the next section, we'll bring all these insights together. We'll explore how to choose your optimal RR ratio based on your personal trading style, win rate, and emotional capacity, and reveal the practical steps to maximize long-term profitability. By the end, you'll have a clear, actionable framework for deciding 1-2 versus 1-3 RR, not based on theory, but based on real trading dynamics that produce results. Because here's the truth. Most traders focus on the RR number and ignore the most important factor, their mind. And it's your mind, not the number, that determines whether you end the year with a growing account or a bleeding one. If you've made it this far, congratulations. You're among the traders who are serious about understanding what truly makes trading profitable. And before we dive in, take a moment to like, subscribe, share, and comment the exact time you're watching. Trust me, the insights in this section could completely reshape how you approach every trade. Now let's bring it all together. Over the last 4 sections, we've explored the theoretical differences between 1-2 and 1-3 RR, how win rate and psychological tolerance affect real-world profitability, how compounding small, consistent wins can outperform chasing high RR trades, real trade sequences and simulated account growth that illustrate the hidden advantage of psychological alignment. So now the question remains, how do you decide which RR ratio is right for you? The first principle is self-awareness. No one can trade your account for you, and no RR ratio is universally best. You must evaluate your win rate. Are you consistently hitting setups at 40%, 50%, or higher? Lower win rates pair poorly with high RR unless you can handle long drawdowns. Higher win rates allow flexibility. Your psychological capacity. Can you handle streaks of 4 to 6 losses in a row without hesitation or revenge trading? If not, a more moderate RR like 1-2 may align better with your mind. Trade frequency. Are you taking trades every day or waiting for infrequent, perfect setups? Frequent traders benefit from smaller, achievable RR ratios, while low-frequency traders may tolerate higher RR targets. Account size and risk per trade. Higher RR often requires risking more per trade to make meaningful profits, increasing the emotional burden. Lower RR reduces this strain, protecting both capital and confidence. Once you've assessed these factors, you can build a practical RR strategy. Here's an actionable framework. Start with a 1.2 RR as your baseline. This ratio is achievable, consistent, and psychologically sustainable for most traders. Track your win rate over 50 to 100 trades. If your win rate is consistently high, you can experiment with higher RR ratios, but gradually, not all at once. Use strict risk management. Never risk more than you can afford to lose on a single trade. Compounding works best when drawdowns are manageable. Monitor your emotional response. If higher RR targets cause hesitation, anxiety, or impulsive trades, dial back the RR until it matches your psychological capacity. Now let's talk about execution, because all the math in the world doesn't matter if you can't execute consistently. A 1-2 RR system produces more frequent wins. This reinforces discipline, builds confidence, and allows compounding to work. A 1-3 RR system produces less frequent wins. Even if profitable mathematically, inconsistent execution due to emotional strain can reduce overall profitability. Consistency is more important than theoretical maximum profit. It's better to grow steadily than to chase occasional massive gains that jeopardize your account. Here's a story that highlights the difference. Trader X tried a 1.3 RR system with a 35% win rate. Early losses crushed confidence, and she began skipping trades or deviating from her plan. By the end of the month, she was down despite profitable setups. Trader Y ran a 1.2 RR system with a 50% win rate. Smaller wins compounded, confidence stayed high, and by month end, his account had grown steadily. He felt in control, disciplined, and capable of scaling over time. This example underscores the critical intersection of math and psychology. Your optimal RR ratio is not the one that looks best on paper. It's the one that allows you to execute consistently without fear or hesitation. Now, let's talk about practical steps you can take immediately. Track every trade meticulously. Note risk, reward, and psychological state before, during, and after each trade. Over time, patterns will reveal your optimal RR ratio. Simulate streaks. Even if your system is profitable on paper, run simulations with losing streaks to see how your psychology reacts. Adjust your RR if streaks feel unmanageable. Start small. Test your RR in a demo or small live account. Observe emotional responses and compounding patterns before scaling. Iterate gradually. Small incremental adjustments to RR, position size, and trade frequency allow you to discover your sweet spot without risking significant capital. Here's the ultimate insight that separates profitable traders from the rest. Profitability is a combination of strategy, discipline, and emotional resilience. RR ratio is just one piece of the puzzle. Even a perfect 1.3 system fails if you abandon it under stress. Conversely, a 1.0 system thrives when executed consistently with discipline and compounding. And remember, trading is not about chasing adrenaline or the biggest win. It's about creating a system that grows your account predictably and keeps you in control. The smaller, achievable wins of 1.2 RR often outperform the big, glamorous wins of 1.13 when you account for psychology, streaks, and compounding. Before we close, here's a mental model to remember. Think long-term, not per trade. One missed opportunity in a 1.2 system is irrelevant. The next consistent trade will compound your gains. Align RR with your psychology. The system is only profitable if you can stick to it under stress. Compounding is king. Smaller, frequent wins create exponential growth over time. Big wins are flashy but rarely sustainable. Finally, if you found this video valuable, take a moment to hit like, subscribe, share, and comment the exact time you're watching. Your engagement helps build a community of traders who understand the real mechanics of profitability, not just the flashy myths. So, to summarize the ultimate truth about 1.2 versus 1.3 RR, 1.2 RR favors consistency, compounding, and psychological sustainability. 1.3 RR can theoretically produce larger wins but is harder to execute consistently due to streak stress and lower frequency of winners. Your optimal RR is the one your psychology can handle consistently while allowing compounding to maximize account growth. Discipline, risk management, and emotional alignment matter more than the RR number alone. Remember, trading isn't about chasing glory. It's about creating repeatable patterns of consistent growth. If you master that, even a modest 1.2 RR system can make you far more profitable in the long run than a high-risk, flashy 1.3 strategy ever could. Take these principles, apply them, test them, and observe your psychology, and you'll discover your sweet spot. That's how profitable traders think, and why they stay profitable while the rest burn out chasing the next big win.